Types of life insurance policies. Industrial life. Insurance issues very small face amounts, such as $1,000 or $2,000. Premiums are paid weekly and collected by debit agents. They were designed for burial coverage. Group life. Insurance written for members of a group, such as a place of employment, association, or a union. Coverage is provided to the members of that group under one master contract. The group is underwritten as a whole, not on each individual member. One of the benefits of group life coverage is usually there is no evidence of insurability required. Ordinary life is made up of several types of individual life insurance, such as temporary term, permanent, whole. Term life insurance gives you the greatest amount of coverage for a limited period of time. Term insurance is only good for a limited period of time because it has a termination date. Term insurance is an inexpensive type of insurance, making it an attractive option for large policies. Term life is the cheapest type of pure life insurance, and due to having a termination date and not having any cash value, it will always be cheaper than a whole life policy with the same face value. It provides a pure death protection since it only pays a death benefit if the insured dies during the policy term. Term is often renewal and convertible. For example, if you have a 10-year renewable and convertible term, after the 10 years are up, the policy terminates or you can renew it. If you renew it, the premium price will go up and you will have the policy for another 10 years. This cycle continues until you're too old to renew or it's too expensive. All term insurance has a final termination date where you can no longer renew it. If the policy is convertible, you can convert it to whole life, think rent to own at any time. Anytime you renew or convert any type of insurance, you do not have to worry about your health, as your insurability is locked in. However, the price will always go up because your attained or current age is used for your new policy. Term is typically thought of as renting. You have a roof over your head, but they're going to raise the price and until it no longer makes sense for you to keep it, or at some point they terminate the contract and kick you out. Level term, also called level premium level term, has a level face amount and level premiums. Premiums tend to be higher than annual renewable term because they are level throughout the policy period. However, the premiums will increase at each renewal. Life insurance written to cover a need for a specified period of time at the lowest premium is called level term insurance. Term insurance always expires at the end of the policy period. For example, if D needs life insurance that provides coverage for the remainder of her working years and wants to pay as little as possible, D would need level term. Level term provides a fixed, low premium in exchange for coverage which lasts a specified time period. Decreasing term life insurance that provides an annually decreasing face amount over time with level premiums. These policies are usually used for mortgage protection. A decreasing term policy is a type of life policy which has a death benefit that adjusts periodically, according to a schedule, and is written for a specific period of time. Decreasing term policies are usually written for a mortgage or other debt that typically decreases over time until it is paid off. For example, a 15-year decreasing term policy could protect a September 15, 2023 mortgage. As the mortgage balance reduces each year, the face value of the insurance policy will adjust accordingly to match. After the mortgage is paid off, the insurance policy will expire. Credit policies are typically purchased using a decreasing term life insurance policy, with the term matched to the length of the loan period and the decreasing insurance amount matched to the declining loan balance. Since credit life insurance is designed to cover the life of a debtor and pay the amount due on a loan if the debtor dies before the loan is repaid, credit policies can only be purchased for up to the amount of the debt or loan outstanding. For example, if you wanted an insurance policy to protect a $20,000 5-year auto loan, you would use a 5-year decreasing term life insurance policy with an initial face value of $20. You will pay the same level premium every month for the 5-year term of the policy. The face value will start out at $20,000 and change according to a schedule, the decreasing balance of the auto loan. After 5 years, the car will be paid for and the insurance policy will no longer be needed. Increasing term. Term life insurance that provides an increasing face amount over time based on specific amounts or a percentage of the original face amount. Convertible term. A term life policy has a provision that allows policy owners to convert their term insurance into permanent policies without showing proof of insurability. Convertible term provides temporary coverage that may be changed to permanent coverage without evidence of insurability. For example, if you take out a term insurance policy when you are young to take advantage of your good health and the policy's lower premium, but want the option convert the policy to a permanent one for final expense benefits once your finances improve, you would want a convertible term life policy. The conversion privilege of a group term life policy allows an individual to leave the group term, temporary plan and convert his or her insurance to an individual permanent policy without providing evidence of insurability. The most important factor to consider when determining whether to convert term insurance at the insured's attained age or the insured's original age is the premium cost. The number one factor which impacts life insurance premium cost is the insured's current or attained age. For example, a $25,000 policy on a healthy 7-year-old boy will cost substantially less than a $25,000 policy on a 57-year-old man. Whether converting an individual or group term insurance policy, although your insurability is guaranteed, your age is typically reevaluated to your current, attained age, not left at the age you were when you applied for the original term policy. Convertible term would allow you to take your temporary coverage and change it to permanent coverage without evidence of insurability or good health, but your premiums will increase due to using your attained age. Renewable term. Term insurance that guarantees the insured the right to continue term coverage after expiration of the initial policy period without having to prove insurability. Renewable term provides temporary level coverage at the lowest possible cost for a limited period of time, but then allows the policy owner to renew the policy to maintain coverage past the policy's termination. When a term policy is renewed, the insured does not have to prove insurability. However, the premium price will rise because the insurance company will use the insured's current or attained age to determine the new premiums. If a customer wanted coverage at the lowest possible cost that was good for a limited period of time, but offered the ability to continue the coverage after the expiration, the customer would want a renewable term policy. Annual renewable term. Term coverage that provides a level face amount that renews annually. This type of coverage is guaranteed renewable annually without proof of insurability. Term rider. A term rider is a type of life insurance product which covers children under their parents' policy. Family plan policies usually cover the family head with permanent insurance, and the coverage on the spouse and children is term insurance in the form of a rider. A term rider is always level term. This is cheaper than every family member getting their own policy. For example, the main policy may be on dad, then mom and the children are riding on, attached to dad's policy as term riders. Term riders allow for additional family members to be covered under one policy by attaching everyone to a main policy. Term riders can also allow an applicant to have excess coverage by adding an additional term rider for them to the main policy. Whole life. Insurance that provides death benefits for the entire life of the insured. It also provides living benefits in the form of cash values. It matures at age 100 and normally has a level premium. Whole life insurance provides both living and death benefits. Provides permanent life insurance protection for the insured's entire life. It also provides living benefits such as cash value and policy loans. Advantages of whole life insurance. Covers the entire life of the insured. Living benefits, cash value, and policy loans. Fixed premiums. Drawbacks of whole life insurance. Protection is more expensive because of living benefits. Premium paying period may extend beyond the income earning years. Whole life is often compared to buying like buying a house. You can pay the house off slowly or quickly, but once it's paid for, you still own the house. There are several types of whole life. All whole life has the same type of benefits. The only difference in types of whole life is how the policy is paid. Some will be paid straight until death or age 100. Some will be paid for after a few years or by a specific age. Some may give you a little discount in the early years to help you get started, etc. All whole life lasts until death or age 100, has a fixed premium and level benefit with cash value accumulation, regardless of how it is paid. Types of whole life insurance include straight whole life, limited pay whole life, single premium whole life, modified whole life, graded whole life, straight life. This is basic whole life insurance with a level face amount and fixed premiums payable over the insured's entire life. Premium payments made until death of insured or age 100, maturity of policy. Limited pay whole life. This is whole life insurance where the insured is covered for his entire life, but premiums are paid for a limited time. As the premium payment period shortens, cash values increase faster and the fixed premiums are higher. For example, under a life paid up at 65 policy, premiums are only paid until the insured is 65 years old. With a 20-pay life policy, the insured only pays for 20 years. These policies are in effect until the insured's death, or they reach age 100. Single premium whole life allows the insured to pay the entire premium in one lump sum and have coverage for the insured's entire life. An immediate non-forfeiture value is created. An immediate cash value is created. A large part of the premium is used to set up the policy's reserve. Modified whole life. Low premiums in the early years and jumps to a higher premium in the later years and remains fixed thereafter. Premiums increase just once. Graded whole life. Under a typical graded premium life insurance policy, the premium increases yearly for a stated number of years, then remains level. Premiums continue to stay level for the remainder of the policy. For example, a policy can start out low in a graded whole life and increase a small amount every year up until the 5th year, then levels off for the remainder of the policy. Special use policies. In addition to the basic types of life insurance policies, there are a number of special use policies insurance companies offer. Many of these are a combination or packaging of different policy types, designed to serve a variety of needs. Family plan policies. These are designed to insure all family members under one policy. Usually the family head is covered by permanent whole life insurance, and the spouse children are included on the same policy as level term life riders, family term riders. The term coverage on the spouse and children are normally convertible to permanent coverage without evidence of insurability, if attached to someone else's policy. Think sidecar on motorcycle. Riders must ride on something. Family plan policy example. Husband whole life policy. Wife, spouse, term policy convertible without proof of insurability. Children term policies convertible, usually at 18 or 21. Without proof of insurability. Premium remains same regardless of the number of children. Family income policies. Whole life and decreasing term insurance begins date of purchase. Provides monthly income to a beneficiary if death occurs during a specified period after date of purchase. If the insured dies after the specified period, only the face value is paid to the beneficiary since the decreasing term insurance expired. Income this concern typically decreases over time because the household shrinks. They use decreasing term instead of level. With decreasing term, the benefit begins to decrease as soon as the policy begins. Family maintenance policy, whole life and level term, begins date of death. Provides income to a beneficiary for a selected period of time if an insured died during that period. At the end of the income-paying period, the beneficiary also receives the entire face amount of the policy. If an insured die after the end of the selected period, the beneficiary receives only the face value of the policy. Maintenance maintains the family using level term. This means the family will receive a benefit for so many years after the insured's death. Multiple protection policies pays a benefit of double or triple the face amount if death occurs during a specified period. If death occurs after the period has expired, only the policy face amount is paid. The period may be for a specified number of years, 10s, 15, or 20 years, or to a specified age such as 65. These policies are combinations of permanent insurance and level term insurance. Joint life policy, a policy that covers two or more people. The age of the insureds are averaged and a single premium is charged. It uses permanent insurance as opposed to term and pays a death benefit when one of the insureds dies. The survivors then have the option of purchasing an individual policy without evidence of insurability. The premium for a joint life policy is less than the premium for separate multiple policies. One policy covers two. Think joint accounts with a bank. Click to add an image or screenshot if necessary. 32 hours. The premium for a survivorship life policy is lower. Juvenile insurance. Life insurance which is written on the lives of a minor is called multiple protection policies. Pays a benefit of double or triple the face amount if death occurs during a specified period. If death occurs after the period has expired, only the policy face amount is paid. The period may be for a specified number of years, 10s, 15, or 20 years, or to a specified age such as 65. These policies are combinations of permanent insurance and level term insurance. Joint life policy, a policy that covers two or more people. The age of the insureds are averaged and a single premium is charged. It uses permanent insurance as opposed to term and pays a death benefit when one of the insureds dies. The survivors then have the option of purchasing an individual policy without evidence of insurability. The premium for a joint life policy is less than the premium for separate multiple policies. One policy covers two. Think joint accounts with a bank. One account, two people. Note: a variation of the joint life policy is the joint and survivor policy, or a survivorship life policy. It can also be known as a second to die policy. This plan also covers two lives, but the benefit is paid upon the death of the last surviving insured. Compared to the combined premium for separate life insurance policies on two individuals, the premium for a survivorship life policy is lower. Juvenile insurance. Life insurance which is written on the lives of a minor is called juvenile insurance. The adult applicant is usually the premium payer as well, until the child comes of age and is able to take over the payments. A payer provision is typically attached to juvenile policies. It provides that in the event of death or disability of the adult premium payer, the premiums will be waived until the child reaches a specified age, such as 18, 21, or 25. Payer provision protects the insured in the event the payer dies or is disabled. Credit life insurance is designed to cover the life of a debtor and pay current assumption whole life. Policies are almost always a MEC due to accelerated premiums. Adjustable life policies are distinguished by their flexibility that comes from combining term and whole life insurance into a single plan. The policy owner determines how much face amount protection is needed and how much premium the policy owner wants. Adjustable premiums can vary to reflect. This is also called current in the insurance. The adult applicant is usually the premium payer as well, until the child comes of age and is able to take over the payments. A payer provision is typically attached to juvenile policies. It provides that in the event of death or disability of the adult premium payer, the premiums will be waived until the child reaches a specified age, such as 18, 21, or 25. Payer provision protects the insured in the event the payer dies or is disabled. Credit life insurance is designed to cover the life of a debtor and pay the amount due on a loan if the debtor dies before the loan is repaid. It is normally issued in an amount not to exceed the outstanding loan balance and is usually paid entirely by the borrower. A decreasing term policy is most often used. Non-traditional life policies. In the 1980s, insurance companies introduced a number of new life products designed to keep up with inflation and are interest-sensitive, most of which are more flexible in design and provisions than their traditional counterparts. The most notable of these are interest-sensitive whole life, adjustable life, universal life, variable life, and variable universal life. Interest-sensitive whole life. Interest-sensitive life insurance is a type of whole life insurance where the cash value can increase beyond the stated guarantee if economic conditions warrant. This is also called current assumption whole life insurance. It also gives the insured the opportunity to either increase the face amount or use the extra cash value to lower future premiums. Premiums can vary to reflect the insurer's changing assumptions with regard to its death, investment, and expense factors. Call current assumption whole life policies are almost always a MEC due to accelerated premiums. Adjustable life policies are distinguished by their flexibility that comes from combining term and whole life insurance into a single plan. The policy owner determines how much face amount protection is needed and how much premium the policy owner wants to pay. Adjustable life insurance allows you to vary your coverage as your needs change without requiring evidence of insurability. Consequently, no new policy needs to be issued when changes are desired. Adjustable life has all the usual features of level premium cash value life insurance. Universal life is a variation of whole life insurance characterized by considerable flexibility. Changes may be made with relative ease by the policy owner with these flexible premium policies. Investment gains go towards cash value, unlike whole life, with its fixed premiums, fixed face amounts, and fixed cash value accumulations. Universal life allows its policy owners to determine the amount and frequency of premium payments which will adjust the policy face amount. Basic characteristics of a universal life policy are flexible premiums, flexible benefits, no minimum death benefit, and cash value withdrawals. Cash value accumulations are subject to a minimum interest guarantee. Any surrender charges of a universal policy must be disclosed. Equity Index Universal Life Insurance, IUL, a permanent life insurance policy that allows policyholders to tie accumulation values to a stock market index, like the S&P 500. Indexed universal life insurance policies typically contain a minimum guaranteed fixed interest rate component along with the indexed account option. Indexed policies give policyholders the security of fixed universal life insurance with the growth potential of a variable policy linked to indexed returns. Potential extra interest based on the investments of the company's general account. Modified endowment contracts, MESI, a policy that is overfunded, according to IRS tables, is classified as a modified endowment contract. Policies that do not meet the 7-pay test are considered MECs and will lose favorable tax treatment. The 7-pay test is a limitation on the total amount you can pay into your policy in the first 7 years of its existence. The test is designed to discourage premium schedules that would result in a paid-up policy before the end of a 7-year period. For example, if yearly premium is $500, in a 7-year period, a total amount paid would equal $3,500. If you paid $3,501, it has now exceeded the 7-pay test and is no longer a life insurance contract. It will now be taxed as an investment. If withdrawn prior to age, there is a 10% penalty. Taxation only occurs when cash is distributed. Funds withdrawn from MEC are subject to last in, first out (LIFO) tax treatment, which assumes that the investment or earnings portion of the contract's values is withdrawn first, making these funds fully taxable as ordinary income. Penalty taxes on premature distributions from a modified endowment contract, MIS-E, normally apply to policy loans. Variable insurance products. Note: because of the transfer of investment risk from the insurer to the policy owner, Variable insurance products are considered securities contracts as well as insurance contracts. A producer is required to register with the National Association of Securities Dealers to sell variable products. Variable whole life insurance was created to help offset the effects of inflation on death benefits. It's permanent life insurance with many of the same characteristics of traditional whole life insurance. The main difference is the manner in which the policy's values are invested. With traditional whole life, these values are kept in the insurer's general accounts and invested in conservative investments selected by the insurer to match its contractual guarantees and liabilities. With variable life insurance policies, the policy values are invested in the insurer's separate accounts, which house common stock, bond, money market, and other securities investment options. Values held in these separate accounts are invested in riskier, but potentially higher yielding, assets than those held in the general account. The basic characteristics of a variable life policy are fixed premiums, a guaranteed minimum death benefit, which fluctuates over the minimum, and cash values which fluctuate and are not guaranteed. Variable universal life, VUL, is a type of life insurance that builds cash value. It combines all the characteristics of a universal life and variable life. In a VUL, the cash value can be invested in a wide variety of separate accounts, similar to mutual funds, and the choice of which of the available separate accounts to use is entirely up to the contract owner. The variable component in the name refers to the ability to invest in separate accounts whose values vary. They vary because they are invested in stock and/or bond markets. The universal component in the name refers to the flexibility the owner has in making premium payments. This provides the policy owner with flexible premiums, adjustable death benefits, a guaranteed minimum death benefit, and gives the insured growth potential for higher returns, but also potential for loss. Evidence of insurability can be required for an individual covered by a variable universal life policy when the death benefit is increased. North Carolina Life and Health